Good afternoon. This is Josh Mindlin here at Chaikin Analytics, and I'd like to welcome you to our presentation of Turn Volatility into Profits, the key to trading options in this chaotic market. Presenting today is Marc Chaikin, founder and CEO of Chaikin Analytics. As a reminder, this webinar is being recorded and a copy will be sent to all registrants tomorrow. Please submit your questions via the Zoom Q&A window, which you can access in the upper left-hand corner of your screen. To get us started, here's Price Headley, the founder of Big Trends.
Oh, thank you, Josh. And it's a pleasure to be with you all today. And it couldn't be a better topic on talking about volatility, chaotic markets, and how to take advantage of it. And frankly, it couldn't be a better presenter than Marc Chaikin. I'm thrilled to hear what Marc has to say and share with us today, because he always gives a very fresh view on how you can take advantage of today's markets from a gentleman who's been in the markets for half a century. I mean, just basically 5 decades of incredible Wall Street knowledge. I had to throw that century in there. But basically, Marc does a great job of sharing with you what he's learned works, which is his unique technical approaches, his power gauge, which is loaded with all kinds of driving factors that make the market and make the stocks go up or down. And so he's going to share that with you today, along with a lot of sentiment work. We were just talking about it before we got started about really why sentiment is so important as well, knowing when everybody gets too negative, that's when you should be ready to buy. So with this reversal we saw today, Marc, I can't wait to see what you have to share with us. And thank you so much for being with us today.
Well, thank you, Price, for turning out such a big contingent of your Big Trends subscribers, and welcome everybody. As Price said, we're in a volatile market. Today is unfortunately the epitome of what we've all been living through, and I know it's not easy. So I want to start the webinar by introducing you to the newest member of the Chaikin community. This is our new Cairn Terrier Scotch, who we got 3 weeks ago, and I'm doing this webinar from home today. So if you hear some barking in the background, that's Scotch. And Scotch has all the attributes of a good trader. He's calm, he's picky, he's selective, he only eats the food he likes, but more importantly, he doesn't panic. And that's what we're going to be talking about in today's webinar. So my background, as Price said, 50 years on Wall Street, and for 45 years I've been using technical analysis, but always in conjunction with fundamentals. And because of that, I've been able to survive 10 bear markets. I know what they feel like. I know how they start. As the Farmers Insurance commercial goes, I know a thing or two because I've seen a thing or two. And we're going to share some of that knowledge with you. Along the way, I've been mentored by some of the smartest and most successful institutional investors. Some of them were clients and some of them were colleagues. And the reason that's important is because I came out of retirement in 2009 to found Chaikin Analytics with my wife, Sandy. And the reason is I wanted to level the playing field for self-directed investors like yourself, who had started to transfer what ended up being $1.3 trillion out of full-service brokerage accounts at Merrill Lynch, Smith Barney, Raymond James, to self-directed accounts at online brokers. And I felt that they needed the kinds of tools that I had created for institutional investors over a 30-year career. And so I created what is the culmination of my life's work, the Chaikin Power Gauge rating. It does the fundamental heavy lifting for you. And we're going to share the components and how it fits into an options trading strategy and how it helps you in a volatile market. I will tell you that I ran the options department at a regional firm called Tucker Anthony and R.L. Day, fine firm. It's now part of RBC. 20 branches scattered throughout New York, New Jersey, all the way up to Maine. Tens of thousands of options traders, and 95% of those options traders, and we're going back to the late 70s and early 80s, lost money in spite of all my good efforts to show them how to use technical analysis. We now have a much more powerful combination, as I said, of technicals and fundamentals. And I'm going to tell you why they lost money and show you how we can solve that problem for those of you who are trading options actively. So I'd like to start out with a poll question to get a sense of what people are thinking. Sentiment is really important. What's your biggest stumbling block on the road to options profits. Josh, why don't you share the choices with people?
Sure. You have 4 choices you can choose from: market volatility, timing, finding the right option strategy, and confidence. All right, I will share the results with everybody.
I'm guessing people said timing.
That would be my guess normally too.
No, this is evenly distributed. Well, this is great. We're going to address a number of these issues in today's webinar. Usually it's skewed to timing. So clearly a lot of prices, people have the timing down because of the great work that price does from a technical point of view. So let's talk about the market. Because in order to trade confidently, that's why we put confidence up as a choice, you have to have some sense of where the market's going, and you have to understand all this noise that we have to deal with on a daily basis. So the stock market went from an uptrend on autopilot in 2017 to now 2 roller coaster corrections in 2018, one in February, March, and now one here in October, November, and December. So let's put that into perspective by looking at a 1-year chart of the SPY. This is the most actively traded instrument in the US markets. It represents the movements of the SPDR ETF, known as SPY, that mirrors the S&P 500 large cap index. So this represents 90% of the market cap in the American markets. And we see a couple of interesting things. First of all, at the bottom of the chart, we now have a power gauge rating for actively traded US equity ETFs. Previously, that line was gray. That's at the bottom of the chart. Power gauge rating for SPY has been bullish. More importantly, we see the progression from what was a W-shaped bottom in February and March of 2018, this year, into another sort of mini uptrend on autopilot. It was pretty easy to make money after March by just buying the dips. And we broke out above 2,800, which defined the phase in which the S&P 500 caught up with the NASDAQ and the small caps and made new all-time highs at 2,940. And that was also a critical level when the uptrend line was broken in October. We dropped below 2,800. That now becomes a really critical resistance level. It was a resistance level in the spring. It became a support level when it was broken to the upside. Now it's a resistance level once again. In our weekly market letter on Sunday, we said big gap up opening due. That was before I saw the futures. The letter came out around 5 o'clock. Don't chase the rally. Why? Because you have 2 ways to buy the market. You can buy dips, like we saw this morning. And most of the charts in this deck were put together around 11:30 or 12 o'clock. So the market was down 2.5%, as you see in the upper portion of the screen on the S&P 500. Or you can buy the market if and when it closes above 2812, which would be a breakout level. Now, what's interesting is that will represent what's known as an inverted head and shoulders. And you normally count from the low, which is 2,600, to the breakout level, 2812. If we close above 2812, and I believe we will, that counts in technical terms to a target of 3025 on the S&P. Nobody's talking about that right now. Everybody's talking about a new bear market, and we'll see sentiment, as Price alluded to, very negative. That's bullish. You want to go against the crowd. Chaikin money flow was bullish on this pullback, both to the first low a week ago, that what I call the Thanksgiving massacre, to the bottom that we experienced today. Extraordinarily volatile, emotional markets. We went from oversold with positive money flow to almost overbought at 2,800, and now we're pulling back yet again. Emotions are raw. It's a difficult time. That's why I love doing these webinars, so I can share 50 years of market wisdom with you. But let's put pullbacks into perspective. This represents 73 years of market activity, and it's about 9 months old, ready to be updated. This comes from Guggenheim Partners. And there are now 77 declines of between 5 and 10% since 1945. We call that a pullback. They average 6%, typically last a month, and within a month you recover to new highs. That's what's known as buy the dips. Once you close below a 10% drop on the S&P 500 index, we call that a correction. There have now been 29 of them since 1945. They average 13%. They last 4 months, and then in another 3 months you recover to new highs. Wouldn't it be nice if we saw a second retest of those 2,600 lows today on very emotional computer-generated selling, and then within 3 months are trading above 2940? I think it's going to happen. And so far, the decline has been about 11%. So we're right within bounds. Once you get beyond 20%, that's a bear market. Now, you've down more than 20% in the NASDAQ and the Russell 2000 small cap index, but most money managers measured against the S&P 500. So we like to use that as our benchmark to define pullbacks and corrections. Now, here's a graphic way to look at that. And this shows you that it's not new. What I just portrayed as a chart or a graph or a table of numbers is nothing new. It shows you what the pullbacks have been like since the bull market began in 2009. Numerous pullbacks of 5 to 10% by the dips. Notice that in 2017, not one pullback of even 3%. It became pretty easy to make money unless you were listening to the headlines. Just like now, there were bears at every inch of the way in 2017. But notice the red circles. These are the times that the S&P 500 closed down more than 10%. And in each of those instances, and in almost every instance since 1945, when you have a decline on a closing basis of more than 10%, your bottom looks like the shape of the letter W, as opposed to that V-shaped bottom that analysts love to call buy the dips. So we're in a very complex pattern here. And I did a webinar on Tuesday and said bottom is in. And I think it was. I took the question marks out. I put them back in. So in the spirit of full disclosure, on Tuesday, I felt very strongly, even though I knew we were going to run into resistance at 2,800, 2,825, that the bottom was in for a couple of reasons that I'm going to show you in a minute. We tested that bottom yet again. Notice that it came within the volatility bands. We use Keltner, modified Keltner bands, not Bollinger bands. They breathe more slowly. They don't contract and expand. They show you intermediate support and resistance levels. So in my view, we're forming a very complex W pattern. The top was the 29th of September, and we're about 2.5 months into it. Could be over. We need a catalyst. We got it last week and Monday with the China trade truce, and then people got really nervous today that the trade truce might end because of the arrest of CFO of the major Chinese cell phone manufacturer. It's all fears that are hyped by CNBC. They see viewership increase when people are afraid, and they're not afraid to stoke those fears. So you had a parade of analysts on telling you we're in a bear market. But then you got some voices of reason. You got Jamie Dimon talking about how the economy's in good shape. You had Christine Lagarde, the head of the International Monetary Fund, saying she thinks that these trade and interest rate fears are overblown. And a Wall Street Journal article saying that the Fed may just take their foot off the brakes and stop raising interest rates, all of which was music to the same segment of the market. So why did I think that the bottom's in, and why do I continue to think that the bottom's in? This is a weekly chart of the S&P 500, courtesy of Stock Charts. It's through last Friday. The market is now traded back down toward 2,600. The low today was in the 26-25 range. And notice how the spike at the bottom comes, sorry about that, I've got a hypersensitive mouse here, comes on the first leg of the W, just like it did. Now, if I were you, I'd be a little annoyed, so I'm going to try and avoid this. 2016, low in January, spike in new lows, low in February, new lows, much more positive. Happened again in early 2018. The spike in new lows accompanied the original bottom at 25.33 intraday. When you tested that low within the volatility bands, higher reading for new lows. Same thing exists today, and sentiment. This is a chart of the 8-week moving average of small trader put buying. Contrary indicator. They were buying as much and as many puts a week ago as they did at the bottom in two recent bear markets, 2002 and 2008. So whether you think we were in a bear market or not, and I don't, but a lot of prognosticators are telling you that, then you have to look at this and say, well, is that supposed bear market over, or is this a great buying opportunity? It's a great buying opportunity in my view. You got to put volatility on your side. And when I look at the likely scenario for 18 into 19, what I see is what's reality: higher interest rates and rising earnings. Now, the 10-year Treasury dropped down to 283 today after that Wall Street Journal article. Maybe higher interest rates are a thing of the past, but interest rates have been going up because the Fed sees the numbers that indicate that the economy is strong. So earnings are rising. Third quarter earnings were a knockout. Fourth quarter earnings are expected to be strong when they're reported in January. And analysts are estimating 7 to 9% year-over-year increase in earnings for 2019. Now, why was the market making no progress for the year of 18? Because price earnings ratios compressed. This is a prescription for the rubber band to snap back the other way and for us to have a really positive 2019. Higher interest rates are bullish if the economy is strong but not overheated. Earnings are rising, and the reality is that everybody who's telling you that there's a recession around the next corner is puffing smoke, because economic downturns precede a recession and thus bear markets. Every bear market since 1960, except for 1987, has been accompanied or preceded by a recession. But when you look at the key indicators that have always turned down before a recession, leading versus coincident indicators from the Conference Board reported once a month, always turned down since 1960. They're making new highs. Housing starts, 12-month moving average, in spite of the fact that every sentiment or report from the housing complex has been bearish for 3 months now, the 12-month moving average of housing starts is still up, and that's turned down before every recession since 1960. So if we're not going to have a recession, we're unlikely to have a bear market. And all this noise about yield curve inverting yesterday was manufactured data. They found some 2-5-year relationship. That's not how you normally define a yield curve inversion. So people are manufacturing reasons to be bearish. And what that all boils down to is fear has gripped the market. So I've gotten very friendly with the CNN Fear and Greed Index. Hard to believe that CNN would create a really great sentiment indicator, but they did, and it's been around for a long time. And it's, as of last night's close, in extreme fear territory, as it has been for a month. Now, a year ago, it was in greed territory, not extreme greed. That happened in January of 2018. So if fear has gripped the market, what do you want to do? Well, this is a contrary indicator. So you want to listen to Warren Buffett. Investors should be fearful when others are greedy, and greedy only when others are fearful. And if you're watching the markets on a daily basis, you know as well as I do that fear is alive and well and gripping the market. So the rest of this webinar, we're going to talk about what tools you can use to deal with volatile, emotional, fearful markets. Now, I did a webinar on Tuesday for advisors, and I suggested this hedge. You can see the S&P 500, the spider was at 2776, just pulling back from 2800. And I said, if you want to hedge a 5% pullback, you can do that for $393, or if you want to protect a $277,000 IRA, $3,930, you could have bought our favorite options strategy on the downside, a vertical put spread. On the upside, we like vertical call spreads. We're going to show you just why and how toward the end of the webinar, so please stay with us. But for $333, you could have protected on Tuesday 100 shares or $27,000 worth of the market. By the way, this spread widened out to $1,000 today. So it's a trading vehicle as well as an insurance policy, and it's cheaper than buying a put option. Notice you could have bought the January 278 put, which was a tad in the money, expiring on January 18th, but you would have had to pay $626. For a third less, you can get the same protection. Those add up over time. So that's from Tuesday. Why didn't I put up a hedge spread here? Because the market's already pulled back 150 points on the S&P. That's a huge move. Actually 175 points. I don't want to be putting on a put spread or selling into a hole, as we say in the professional side of the world. You don't want to sell into a hole. You want to sell into strength. So the problem is what to buy and when to sell, and the solution, we think, is in Chaikin Analytics. But underlying everything we do, and this slide is probably the most important slide in the whole deck, fundamentals drive the market. I believe that for 50 years, but emotions drive the market to extremes. Did we see emotions today? Oh my God. I turned the sound off on CNBC because it was just too much to bear. For me, the path to profits has always been a combination of fundamentals and technicals, and that's what Chaikin Analytics focuses on. Education to show you how you can take a very disciplined approach to fundamental analysis, which is not easy if you don't have the kinds of tools that we provide, and combine it with unique way to look at technicals. Now, those of you who are members of the Big Trends community get the benefit of Price Headley's wonderful short and intermediate term technical analysis. But because we've taken a unique approach to this combination of fundamentals, we've attracted some really successful traders and investors. Some of the big institutions that used to be clients of ours, like Fidelity Investments and Paulson Hedge Fund, traders like John Najarian and Jim Cramer, and Price Headley at Big Trends, who I have the utmost respect for. Why? Because he's a CFA. He knows how important fundamentals and technicals are. In addition to being a great technician, he passed this owner's 3-year exam to be a chartered financial analyst. That's the value he brings. And we try and complement that. Now, at the centerpiece of everything we do is the Chaikin Power Gauge rating. It's a rating that goes from very bearish to very bullish, analyzes 5,000 stocks, lots of number crunching going on under the surface. And now we also have a power gauge rating for all active US equity ETFs. So what's important about this? Well, what's important is you can't do the fundamental analysis yourself. I couldn't do it. Wall Street pays their analysts a lot of money to crunch the numbers that you see on the right, come up with a conclusion. Chaikin Power Gauge rating cuts through the clutter, distills 20 factors, as we'll see in a minute, down to 4 primary factors. Very clear, objective, can't misunderstand it. The gauge tells you what, and the 4 factors tell you why. So earnings, technicals, and expert opinions are driving Starbucks to a very bullish rating. That chart's a little bit old, but the rating's still very bullish. Now, what is the Chaikin Power Gauge rating? Well, it's a multi-factor model that was built in 2010, hasn't changed. It's got almost 8 years of real-time performance. 4 primary factors: value, growth, technicals, and sentiment. And the reason it's worked is it's based on how Wall Street works. It looks at the factors that successful institutional investors look at every day. But what I learned in 30 years of working with these institutions is that they all have different styles and different time horizons. So value investors like Warren Buffett, Cliff Asness, all the people in the Mid-Atlantic region that I work with in the 80s and 90s look at free cash flow to market cap and price to sales. They don't want to pay too much for a dollar of equity. They used to look at price earnings ratio, doesn't work as well anymore. Growth investors, Jim Cramer, the people up in Boston, T. Rowe Price, looking for earnings, sales trends, consistency. Technicals are only 15% of the model, and sentiment is our secret sauce. What are the smartest people on Wall Street doing and saying with regard to stocks? So we look at short interest. Short sellers are the smartest people on Wall Street. They do great research. To survive in a 9-year bull market, you've got to be smart. So if there's a high short position, that has a negative influence on our rating. We look at insiders. Who knows a company better than insiders? But believe it or not, these factors are not normally in quantitative models. Even quantitative analysts have their bias. They're supposed to be unbiased. And they're looking for metrics. I like to look at what smart people are doing. So we look at whether analysts are raising or lowering their estimates. That triggers from earnings surprises. We're going to come into earnings season in January. That'll come into play. And industry group strength. It's like a tailwind that improves your performance. If you're trading the long side in stocks with strong industry groups, you're going to do better. And so we look at industry group relative strength. What's the performance been? Very bullish stocks, up 20% a year in the Russell 3000 over an 18-year period. Some of that's back-tested, but from January 1st of 2011, these are real-time numbers, and they mirror this chart. Very bearish stocks, up only 1%, and that's after a 9-year bull market. If we were looking at this 5 years ago, they would have been down. As they were in 2015, I can't tell you how many people lost money in energy stocks that were in their own bear market in 2015. And the signs were clear. The power gauge rating was bearish on the whole energy complex, starting in 2014 in January, flowing through to the Kinder Morgans of the world in March of 2015. Small caps were in a bear market. So we've often been asked, well, sure, the power gauges worked. We've been in a 9-year bull market. What happens in a bear market? Well, my response has always been, and they usually say, well, you could throw darts and make money in a bull market. And my response was in 2015, 16, well, that's true unless your dart landed on an energy stock. And a lot of people were seduced by the high yields from stocks like Kinder Morgan, the potential and fracking range resources. You need an objective way to judge fundamentals. And the reason fundamentals are strong is because options traders don't understand the importance of fundamentals to successful trading. Price Headley does, great endorsement. Thanks for sharing. By pointing traders to the leaders, you find stocks that you can go back to and buy the dips over and over again. I like the fact that it combines fundamentals and technicals for stock selection and then gives timing signals. You need fundamentals to be confident. One of our 4 answers to the poll question was confidence. If you're not confident and focused, you're going to miss opportunities and make emotional decisions. So that's a good lead into a pattern that we've identified that served our subscribers very well for over 7 years. We call it the classic Chaikin bull. The power gauge rating is bullish, meaning the fundamentals are positive and the stock is likely to outperform the market. Relative strength is strong, telling you that the stock is outperforming the market. And Chaikin money flow is strong, telling you that institutions are accumulating the stock. And that's really important because you want to be on the same side as the big institutional investors. Now, we read the chart from the bottom up. Why? Because the power gauge rating is at the bottom. This gives you what I call your directional edge. That's what's missing. That's why 90% of options traders lose money. They don't have that directional edge. So the directional edge on Cigna has been bullish here for most of 2018. We then look at the relative strength. We convert it to a red-green heat map. Cigna has been outperforming the market since September. Chaikin money flow, CMF, if you're using stockcharts.com, it's on all of your online brokerage platforms. Big mountains of green telling you that the institutions were accumulating the stock. And then we've got buy signals. So you want to buy on dips in stocks that are strong. You saw a dip today in Cigna. Wonderful buying opportunity down near long-term support at our long-term trend line. What is a classic Chaikin bear? It's just the reverse. Power gauge rating is bearish, telling you that the stock has poor fundamentals, underperforming the market. Chaikin money flow is red, not green, telling you that institutions are selling the stock. So again, let's look at the chart from the bottom up. Power gauge rating for Wynn Resorts, bearish. Underperforming the market, that means the market agrees with the model. That's really important. Why? Because no matter how good your fundamental model is, if the market doesn't agree with you, guess who wins? As my good friend Marty Zweig said, Mr. Market always wins. Don't fight Mr. Market. And institutions were selling the stock. So here we had a stock beginning in the spring of 2018 that was a classic Chaikin bear. That means you want to get it out of your portfolio if it's a stale holding. If you've been trading it from the long side, switch gears and start looking for put buying opportunities. So all of this can be encapsulated in this pyramid. Successful trading in any market, particularly in volatile markets, demands a disciplined methodology, and you need an edge. And Chaikin gives you that directional edge. So at the top of the pyramid, the power gauge rating and industry group strength. Those are your fundamental, big picture, macro views of both industry groups and individual stocks. At the bottom of the pyramid, Chaikin money flow and relative strength, so you know whether you're trading on the same side of the market as the big players. And then buy and sell signals in the middle, that sweet spot for options traders that helps you get in and hopefully get out at the right time. So I'd like to throw in a little bit of a bonus, a curveball that we didn't talk about at the beginning. We call this the secret sell signal that 95% of traders never see. And it's known as the Chaikin bearish money flow sell alert. Institutions like to operate in stealth mode because they're paranoid that people will know what they're doing, whether they're hedge funds or big mutual funds or active managers. So what is a bearish money flow sell alert? Well, first of all, you can spot this on your brokerage platform or on stock charts. It happens when a stock rallies up to a short-term overbought and Chaikin money flow stays red. Instead of popping up above the zero line and going green, it stays red or negative. And we saw 2 of them in Mohawk Industries, carpet company and the home furnishings group. that's been suffering because of a weak housing market. And by the way, at its all-time high up at 280, money flow was negative, not positive. So even at the all-time high, which is the ultimate bearish money flow sell alert, as we'll see in a little bit in Apple, someone knew something. This is smart money using strength to get out of a stock. So very often stocks will rally because of short covering, because of hope ahead of earnings reports. When you get an overbought, Chaikin money flow should go green. When it doesn't, we call that a bearish money flow sell alert. Now, everything we've looked at, we call the ideal setup. Warren Buffett calls it the fat pitch. He's famously said they don't call balls and strikes on Wall Street, so you don't have to swing at every pitch. You can wait for your pitch. Well, the key to that is timing. And so we have 6 pairs of buy and sell alerts in Chaikin Analytics. And we have a dashboard in our iPad and desktop app to tell you which stocks in any list that you create or any ETF or market index have triggered a buy signal on a given day. But many of our clients said to us, we don't check into Chaikin Analytics every day, a couple of times a week, certainly on the weekends. So in early May, we introduced daily email alerts. They come into your inbox at 8 in the morning, and they tell you which stocks in the list that we call My Stocks, which you create, or in any other big list like the S&P 500, have triggered buy or sell signals. So on November 9th, HFC, Holly Frontier, triggered a relative strength sell signal. Now, I took a little bit of ribbing in Thanksgiving week because I mistakenly called it Holly Farms, I think thinking about turkey. But the reality is relative strength sell signal at 65.74, also a relative strength breakdown in ConocoPhillips, another energy stock. So let's see what happened to Holly Frontier, a big oil refiner. Well, the first arrow is when that sell signal happened, 65.74, dropped all the way down to 56, and then it rallied up and triggered another relative strength sell signal. And this morning it dropped under 55. These are powerful signals. What is a relative strength sell signal? It's my favorite trading signal for options and swing traders. The reason is these signals tend to last for 4 to 8 weeks. So you can put on an options position that's not stressed by premium erosion or short duration. And in this case, this relative strength sell signal came after what we call a bearish personality change. When a stock has been outperforming the market for a significant period of time, so our relative strength indicator is green, and then begins to underperform the market, we call that a bearish personality change. So you want to be on the right side of these bearish personality changes. You don't want to be the wrong side of the door when Jack Nicholson's coming through with the axe, and that's what a bearish personality change can do for you. And on the reverse, in Cigna, our classic bull, you had a bullish personality change back in the spring. So it works on both sides of the market. And here's a recent example of a bearish personality change that saved a lot of money for our clients. AMAT had a bullish rating in our system for most of 2017. The stock had been outperforming the market, semiconductor equipment along with Lam Research, very, very strong when Micron and NVIDIA and Advanced Micro were making new highs. And then something happened in April, a bearish personality change. The stock went from outperforming to underperforming the market. And when that happens, we look for the first sell signal as a great put buying or a vertical put entry point. And if you had waited for that, you would have been buying puts on AMAT at 50 on the way down to 30. So here's a recent example of a bearish personality change where everything was lined up. Institutions were selling. Stocks started underperforming the market. Power gauge never went bearish, but that didn't matter because relative strength stands alone as a bearish or bullish indicator. Now, you can use bearish personality changes to help minimize your exposure to danger and risk. Enables you to play what we call good defense. So here's another example. Whirlpool Corp, same industry group as Mohawk Appliances instead of carpeting. Power gauge rating has been bearish since late January. There's the bottom of the chart. Underperforming the market for a year now. Institution selling, so you want to look for those sell signals to get out of a stale position or initiate a bearish vertical put spread. And these trades really work. They work 70% of the time. You can see one that didn't work here at the bottom. It worked very briefly. You had to be nimble after the earnings report. But this is the kind of discipline that you need to apply in volatile markets. And the stock was trading back again today. Still underperforming the market, hasn't yet switched. Now, we screen for bearish personality changes in Chaikin Analytics, and people are doing this every day. And on the screen that I did about a week ago, 8 stocks out of the S&P 500 had recent bearish personality changes, including some of the big names like Adobe and Amazon, and Apple, which actually had back then a bearish power gauge rating. So let's look at Apple. Been outperforming the market along the way. It had bullish ratings. The relative strength buy signals work. You can see that 4 to 8 week time horizon. So starting in January when it was underperforming, a wonderful sell signal. 3 good buy signals. The 4th doesn't work. There's your 70%. And then you get a bearish personality change. And the power gauge turns bearish. Now, why did the power gauge turn bearish? Because when they reported their earnings in late October, Apple said, we're not giving out metrics anymore about cell phone sales. Well, analysts didn't like that. They want transparency and they want as much information as they can. So day by day, week by week, and you've heard about this on CNBC, Jim Cramer has become the cheerleader for the next downgrade. Analysts keep downgrading Apple. Even if they're not just following the leader here, they don't like the fact that they've got less information than they used to have. Now, what's interesting is at the top at 2:30 in late September, we had a bearish money flow sell alert on Apple. When Apple made that new high, look what was going on with smart money. Were they buying the stock? No, they were selling the stock. Selling the stock into strength. Smart money was exiting the party. They knew something or thought they knew something, and that's a powerful signal. You want to exit with them. If you didn't exit there, you at least want to recognize the bearish personality change and the power gauge rating turning bearish so that you're not bottom fishing in Apple. There are better, higher probability stocks to be buying on this current weakness. And notice how Apple didn't rally with the market because the analysts are bearish. Those are 2 of the 3 analyst-related indicators in Chaikin Analytics, and made a new low for the move today. Netflix, bearish personality change, bearish power gauge rating. What do you want to do? You want to sell the rallies. So we have our overbought sell signal, a new 8-day high in the stock with a bearish power gauge rating. But notice the progression from bearish personality change to bearish power gauge rating to institutional selling. And you've got a stock in a downtrend that you want to be selling on strength. But that first sell signal after the bearish personality change is your real low risk entry point. It came up here at around 365. Now let's look at NVIDIA. Wow, my mouse is just going nuts today. So NVIDIA was the darling of Wall Street all through 2017. Chips for Bitcoin, for AI, for gaming, their traditional business, for cloud computing. Every buzzword in the world was associated with NVIDIA. And at times, the power gauge rating was bullish and it was outperforming the market. But after that peak at about 288 in October, the power gauge turned bearish on October 5th at a price of 260. 2 weeks later, Goldman Sachs made NVIDIA a conviction buy. That's their strongest buy rating. Where was the stock? 240. What happened? It dropped to 140. This is not a knock on Goldman Sachs. Wall Street research, like everything in life, is not perfect. You need an objective way to evaluate stocks, because if you were watching CNBC, you saw this article and analysts being interviewed. How do you trade NVIDIA after Goldman Sachs upgrades it to a conviction buy with a price target of 305? Well, it turns out Goldman Sachs reversed course about 2 weeks later when the stock was trading at around 200 and said, whoops, we were wrong, a Rick Perry moment. And if you were following Chaikin, you weren't swayed by that because the power gauge was bearish, underperforming the market, institutions selling. You're looking for spots to sell the stock, not buy it. Now, let's look at how you can make money in volatile markets using options. Volatility plus fear, which is exactly where we've been, and this slide is not one that I created today. We've been using this slide off and on since the early part of 2018. Volatility plus fear equals opportunity. When you're in a roller coaster market, there are options, opportunities with limited risk and outsized potential if you follow the Chaikin power gauge ratings. Now, we've embedded options play ideas. That's where the spider bearish put spread came from. By licensing options play and putting it into Chaikin, you can trade options on hundreds of stocks in addition to those 5 wonderful FANG stocks plus Apple that price is guiding you on. But you need rules-based entries, and we've showed you some of them. So what I'd like to end the webinar with is the idea that by using bullish vertical call spreads on stocks that led the market to new highs like Amazon, Google, and Salesforce, but not Apple because the power gauge rating is bearish, you can take advantage of volatility. So why vertical call spreads? Well, a very quick, and I mean quick primer in options trading. Simplest way to use options: if you're bullish, you buy a call option. If you're bearish, you buy a put option. If you've got someone like Precede guiding you, that works beautifully. If you're on your own, then you need a little bit of an edge. And the reason is something that's known as premium erosion or time decay. An option is a wasting asset, expires worthless if it's not in the money. And typically in the last 30 days, you get the biggest premium erosions, especially with at the money or in the money options. Out of the money options, ironically, don't decay that much, but they're a losing game to begin with. So how do you put premium erosion on your side? Well, you do it by using vertical spreads. Vertical spread, if you're bullish, you buy a low strike price option that's either at or in or slightly out of the money, and then you sell an option at a higher strike price to regain some of your costs, so you lower your cost, and then premium erosion works for you, not against you. So let's look at those 3 examples. Amazon had a really nice rally off a double bottom, got up almost to 1800, right under our long-term resistance level of about 1850, and then started to pull back. And I believe the low today was around 1600. As I said, I took these charts early in the day. So at that point, Amazon with a neutral rating, not a bullish rating, so it doesn't meet all of our criteria for a classic bull, but my view is if the market's going to go to new highs or rally into year end, that I want to go away from the defensive stocks like Verizon that have done quite well here, or the healthcare stocks or the food stocks, and go to the stocks that drove the market to new highs. They'll come back. They've been bid down to pretty reasonable levels, given the recent peak at 2,000, 1,400 or so was very cheap on Apple. Now you've made a higher low. So what does a vertical call spread look like on Apple? Well, you buy with the stock at 1630 this morning. Options play suggested buying the option that was slightly out of the money, 1640 call expiring on January 18th. Give yourself enough time. And selling the 1850 call against it. Cost $6,740. 100 shares of Apple is $163,000. And you have unlimited risk. Even if you bought 10 shares, you have unlimited risk. Your alternative is to buy the call option. That would have cost you $8,880. So buying the vertical call spread cheaper, and the profit potential is higher, over 200% profit potential if Amazon trades up to that long-term resistance area between now and January 18th. Pretty good risk-reward ratio. And you know what your risk is. It's limited to the cost of the spread. Let's look at Salesforce. Salesforce had an even better rally. It got almost up to and through the long-term resistance level up here at about 148. I love this company. Jim Cramer loves it. Management is strong. They're in cloud computing with a very strong software package, CRM system that the advisors use and that businesses use. How do I play Salesforce? Well, I could buy the stock at this morning, 137. The recent low was 115, so I may not want to buy a stock where I've potentially got 22 points of risk. So I'm looking at the vertical call spread. Again, these are not recommendations. They're meant to be ideas to stimulate your thinking. Do your own research. Cost $488. What's the spread? Buy the 140 call, which was slightly out of the money. Expires January 18th. Sell the 155 call against it. So you're betting that the stock's going to go up about 12% from 138 to 155 over the next 6 weeks. And what's your profit potential? Well, it's less than 100%. Therefore, options play, which rated Amazon as a 107 with a big check mark, is rating Salesforce as a 99. So I'm going to pass on this one. Again, it's the old Warren Buffett saw that you don't have to swing at every pitch. Even though I like Salesforce, I'm going to pass. I favor Amazon and I favor Alphabet. Alphabet, of all the FANG stocks, is probably the least troubled. They don't have regulatory problems like Facebook. They don't have concerns about the retail climate like Amazon. Netflix, I think, is way overdone. I'd be looking to sell that stock. Google or Alphabet is doing everything right. They've got new technology. They've got a lock on search and search advertising. And they seem to be getting their act together. So if I'm looking to establish a position in Google thinking that it might rally to 1150 at long-term resistance, what do? Do I buy the stock and spend $105,000 for 100 shares? No, I buy a vertical call spread, $1,045 to control 100 shares of Google for the next 6 weeks. You buy the 150 call, you sell the 1160 call against it, you reduce your cost dramatically from $4,500 to $3,500, and you get that nice big green probability circle with the check mark. This is a higher probability trade. Now, again, the power gauge rating is not bullish for any of these stocks. So this is my way of implementing a bullish trade in a stock that I think is going to lead the market to new highs. And again, 200% profit potential if the stock goes to that long-term resistance of 1160. Now, what about Apple? Well, I said I wouldn't buy the vertical call spread in Apple. Why? Because it's a classic bear now. Power gauge rating is bearish, underperforming the market. Institutions are selling. It's making new lows in a steep downtrend in a weak industry group. It's got everything going against it. So instead, if I was going to put on a position in Apple, and I would only do this on strength, vertical put spread. For $442, you can buy the 170 put this morning, which was slightly out of the money. You'll be able to put this on at a better price if the market rallies. Sell the 155 put against it. Amazingly, you can do that for $442 per 100 shares with huge profit potential. So this gets a 135 rating in options play. Very disciplined way to look at options opportunities, combining fundamentals and technicals. Most of the time here, looking at bearish fundamentals and looking at a very, very attractive risk-reward ratio on a bearish strategy. So everything we've been looking at is part of Chaikin Analytics. It's a proven stock selection system with options play ideas and daily email alerts. It's the full package. Normally retails for $2,195 for an annual subscription. You can go to chaikinanalytics.com/options. But for the big trends community and others of you who are on, we have a webinar special reducing the price to $1,895. Go to chaikinanalytics.com/options, and the offer expires on Sunday, December 9th. Now, you've seen the screener when we look for bearish personality changes. You've seen the options play ideas module. And in addition, as a Chaikin subscriber, you get member-only access to our weekly strategy webinar with our chief market strategist, Dan Russo, who's been nailing the short side. Unlimited coaching and support, including small group and one-on-one coaching, and Dan Russo's daily morning insights in addition to my weekly market insights. Now, Jim Cramer sort of summed it up. He said, I want to explain why I love Marc Chaikin's stuff. It's simple, it's understandable, it's rational, it's not emotional, and you know I use it constantly, almost never want to go against it. That was in our one-on-one webinar on November 7th. So I'd like to give you a fast action bonus. If you join the Chaikin community by midnight tonight, we will send you 4 weeks of Dan Russo's Bearish Market Insights, our weekly bearish newsletter. And Dan's really been nailing it even when the market was going up. So fast action bonus, call today. We'll take an additional $100 off, so you save $400, reducing the price to $17.95, plus complimentary 4 weeks of Mastering the Bear newsletter. So with that, I'd like to see if Price has any closing comments to wrap up the webinar.
Wow, Marc, you always bring so much to the table. I always love listening to you from the beginning to the end and learning something myself, because you see what Marc has done here, folks. He's really brought it all together. You know, when you start with the market assessment, but then you're breaking it down between why Amazon looks one way, why Apple looks another way. And by the way, Marc, a lot of your stuff syncs up with the big trends methodology as well, finding both the technicals and then those fundamental catalysts like earnings reactions, because as you said, the institutional community, the analysts and the institutions are really driving this thing. You're able to see that, folks, with all this stuff on Marc's fantastic software, and you're never left hanging. He gives you all these ongoing resources to keep you plugged in to what's moving up and what's moving down. I think we're moving into that kind of market that basically you're seeing a lot of shifts between the sectors where, you know, there's always a bull market and bear market somewhere, but it's even more dramatically the case, you know, especially as we come out of this correction. You're going to see a lot of stocks that go up a lot more from these levels, but also a lot that get killed from these levels. So you want to be positioned to take advantage of that into 2019 and beyond. And this is fantastic, Marc, with the savings. Thank you so much. And the bonuses. And you just basically you're getting from a Wall Street veteran of 50 years plus. I mean, just the kind of insights that you can use going forward, bull, bear, or sideways. And I love, by the way, what you did, Mark, with the timing on teaching people about the debit spreads up and down, because it's a great time to be selling some options against the other options you might buy because volatilities are high. So timing is everything on those option strategies too. So you really get it all, folks, not just stocks, but options and Mark's insights on the market going forward. So thank you, Mark, so much.
Well, Price, thank you so much for the partnership and the friendship that we formed over the last 3 years, and for turning out such a big part of the Big Trends community. With that, let me turn it back to Josh Minlin to wrap up the webinar.
Thank you, Mark. Thank you, Price. And thank you, everybody, for attending today. To take advantage of Mark's great offer, you can use the link, which is in the chat window right now. That's www.chaikinanalytics.com/options. Or you can call us. If you have any questions, you can speak to my colleagues at 877-697-6783. Again, that's 877-697-6783. You'll immediately get Mark's weekly note. You'll get Dan Russo, who's our chief market strategist, daily morning insights. You'll get access to all of our member support team and the archives. We can get you up and running immediately. Again, you can call us at 877-697-6783, or the link is in the chat window. It's www.chaikinanalytics.com/options.